Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 5 companies who have been paying out a quarterly cash dividend for over 100 consecutive years. Dividends are one of the purest forms of passive income. You make your initial investment and watch the quarterly cash flow continue to come into your portfolio. And these 5 companies in today's video have been providing their shareholders with that quarterly cash flow for over 100 consecutive years without missing a payment. They are some of the strongest companies in the world, and they've operated through every recession and depression and continue to reward their shareholders with this consistent cash flow. So in this episode, we're going to take a look at these 5 different companies, go over their current operations, their recent growth, their dividend, and their current dividend safety. But before we jump into stock number 1, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course today we're going to focus on the very impressive companies who have been paying out a quarterly dividend for over 100 consecutive years. And now as we jump straight in to stock number 1, it's ticker PG, which is Procter Gamble. They trade for $135 per share, and this is one of the leading consumer companies in the world right now. They have a market cap at $326 billion, trading with a forward PE of around 23.6 and a current dividend yield of 2.6%. And on the 1-year chart, they're up by 13% overall, and on a longer term chart, they continue to perform very well, up by over 102% over the past decade. And Procter Gamble has been paying out a dividend for 130 years. 130 straight years, they've been rewarding their shareholders with the cash flow, which is absolutely remarkable. And currently, this company is a dividend king, and for 64 straight years, they have been giving that dividend an increase every single year as well. So one of the few companies that has a dividend growth streak of over 50 years, and in total, they've been paying out a dividend for 130 years overall. So they've been paying out a dividend since the late 1800s, which is absolutely remarkable. And we can see that they operate in 10 different categories of the consumer sector made up of home care, family care, oral care, and many more. And Procter & Gamble has been able to operate for such a long time because they sell pure necessities. Through every economic recession or depression, consumers still need their home care, their family care, their baby care, their hair care. All these different products that Procter & Gamble provides are still always necessities through any economic environment, which has allowed the company to continue to operate and grow for over the past 100 years. And going forward, Procter & Gamble is still not done, and they're forecasting organic revenue to grow between 5 and 6% over this next fiscal year as well. And taking a look at this current point in time, this dividend king has a current yield of 2.6%. Their payout ratio sits around 62% of their net income, which is very safe and very sustainable, leaving them enough room to continue to grow that dividend while also reinvesting back in the business. And their 5-year dividend CAGR is at just above 4%. And PG comes in with the highest dividend safety score possible, coming in with a 99, meaning that over the short and medium term, it's very unlikely that we see a dividend cut coming from this company, and they've already proven that for 130 straight years, they can pay out a dividend, and I don't think that streak's going to come to an end anytime soon. So the first company in this episode that's been paying out a dividend for over 100 consecutive years is, of course, the consumer giant in Procter & Gamble. And now we're going to continue on into stock number 2, which is another boring consumer brand under ticker CL, which is ColgatePalmolive. They trade for around $84 per share. They're up over 14% over the past year, and they have a market cap just above $70 billion and a current yield of 2.1%. And another boring consumer company that's been paying out a dividend since 1895. So for over 125 straight years, they have been making cash payments to their shareholders. And Colgate is a dividend king as well, and their current growth streak sits at 57 consecutive years, which is very impressive. And this company operates similar to Procter & Gamble within the consumer sector, and they sell oral care products, personal care, and home care goods as well. So another boring company that sells necessities consumers use every single day. And for a boring company that many people overlook on the market, they continue to grow. Their organic sales have been picking up as of late, and in the past quarter grew by 8.5%. And on a longer term chart, for the past 5 years, for such a boring company that we probably use their goods every single day in our daily routines, their total revenue, slow and steady, continues to grow to over $16.7 billion in the trailing 12 months. So the company's still expanding and is not slowing down at this current point in time. And we can see they offer a dividend yield right around 2.17%. Their payout ratio at 55% of their net income is sustainable over the longer term, and their 5-year dividend CAGR is right around 3%. And their dividend safety score currently sits at a 90, so it is considered very safe, and another brand very unlikely to cut their dividend anytime soon. So Colgate was the second company that's been paying out a dividend over the past century, and another consumer brand that might be worth taking a look at for your own portfolios. And now we're going to take a look at stock number 3, which is ticker KO. That's Coca-Cola, another brand that I'm sure we've all consumed their products, and they trade for $55 per share. They're up by 18% over the past 12 months, and this company has a market cap at $239 billion with a current dividend yield just above 3%. And Coca-Cola has been paying out a dividend since 1920. So for around 101 years, the company continuously pays out their investors in the form of a quarterly cash. And this is another dividend king as well. The first 3 names have been growing their dividend for over 50 straight years, and Coca-Cola's current streak sits at 57. So very impressive, and another strong brand that's recognized all around the world. And the company has a focus of building out a total beverage company and selling different products under 5 main categories. First, of course, is the Coca-Cola name brand. Then they have their different sparkling flavors, nutrition, juice, dairy, and plant-based goods, as well as different hydrations and sports drinks, and also some emerging beverages as well. And although they already are the leader in the beverage sector on the global scale, the company is not slowing down. They have a major pipeline of innovative products that have either just been released in 2021 or are planning to be released over the next few years. And some notable brands include AHA, Costa Coffee, Coca-Cola with Coffee, and a new addition to their Smart Water line. So the company is not slowing down and continues to innovate to remain the leader in the beverage sector and continue to grow their market share on a global level. And we can see that even for a company that's been operational for over 100 years, they're the well-known brand, they've been leading the market for decades over decades, they still believe they can continue to grow for many years in the future as well. And their long-term growth targets are organic revenue growth between 4 and 6%, their operating income to pick up between 6 and 8% per year as well, and what's impressive is their earnings per share. They're forecasting between 7 and 9% annual growth over the longer term as well. So definitely another consumer brand that may be a nice addition for your portfolio. And with a Coca-Cola right now, you can buy in for a yield at around 3%, a payout ratio making up 77% of their net income. Their 5-year dividend CAGR sits around 4.25%, and the dividend is currently considered safe, coming in at an 80 from Simply Safe Dividends. So another brand we all know, many people love, many people are loyal to the Coca-Cola name brand and will not sway away from their products and will always choose them amongst their competitors. So another company been operational over the long term and definitely worth taking a look at for your own portfolios if you're seeking some growing passive income every single year. And now we're going to transition into stock number 4, which is ticker ED, Consolidated Edison. They trade for around $77 per share, pretty much flat over the past 12 months, only up by 2.5%. They have a market cap at $26 billion, a forward PE of only 18, and a nice high dividend yield right around 4%. And this is another boring company, which is a utility. And like I've mentioned pretty much for every name we've gone through, these are all boring companies. And boring companies are what you want to own for the market as well over the long term. They have consistent cash flow, generate revenue year after year, net income, and are always profitable, and these are the brands that have the ability to pay out those dividends to investors for many decades to come. Boring's good. Not every investment you make has to be super flashy, doesn't have to be a high growth tech company, doesn't have to be a brand that's expected to explode 500% over the next year. Sometimes slow and steady does win the race, and you can find that with any of the names we've gone through in today's video. So of course, if we take a look at Consolidated Edison, ticker ED, they've been paying out a dividend since 1885. So for over 125 years as well, they've been paying out that dividend to their shareholders. And this is a large utility company operating and controlling a majority of the New York market. The company operates through a regulated electric, gas, and steam delivery business model, and they serve Manhattan, the Bronx, parts of Queens, and Westchester County. So they operate pretty much in the main sector of New York, a highly dense and very populated sector of the North American economy. And right now, you can pick up some shares of ED with a yield above 4%, a payout ratio right around 72% of their net income, slow dividend growth right around 3.13%, and the company is very close to becoming a dividend king with a streak of 47 straight years. So not there yet, but in 3 more years, they will achieve the dividend king status. And currently, they are considered very safe, coming in with a 90 and a very low beta, so buying into ED may stabilize your portfolio if you already are very volatile and may provide some consistency during recent times of high and low dips that we've seen as of late. So this was ticker number 4, ED Consolidated Edison, a nice utility company with a yield above 4% in dividends over the past century. And now into the 5th and final company that we're going to go over in this episode. It is ticker LLY, which is Eli Lilly. They trade for $202 per share. They've grown by 29% over the past year, and over a longer term, they have performed incredibly well, growing by 430%. Their market cap is at $181 billion. They have a forward PE right around 25 and a current yield of 1.7%. And this is a big pharma company. They're one of the leaders in the healthcare and pharmaceutical space, and they continue to develop new drugs year after year. And they began paying a dividend back in 1885. So for over 130 years, the cash flow has been coming from this company. And we can see in Q1 2021, another brand that still delivers very strong growth. And their quarterly revenue picked up 16% to start out this calendar year, which is absolutely phenomenal. And over the past 5 years, another company consistently going year after year, growing their total sales to over $25.4 billion in the trailing 12 months. And at this current point in time, the yield sits at 1.7%, so it is on the lower end, but their payout ratio is very sustainable, only at 42%, and their dividend growth CAGR at 9.5% is the fastest we've gone through out of all 5 companies. So although they have the lowest starting yield, that annual dividend payment is compounding at a much faster rate than the other competitors we've gone through in this video. And of course, their dividend is considered very safe, coming in with a 96, and this is another low beta company. And just last year, they grew their annual dividend by 15%, so you are getting some fast acceleration along with a high moving share price. So Eli Lilly was company number 5 in today's video. And now we're going to wrap everything up. I want to thank you for watching to the end. And like you saw throughout the entire episode, all 5 companies we've gone over, they've been paying out a dividend for over a century, but they are all considered safe or very safe in regard to their current financial situation. So even after 100 straight years, their dividend is still considered safe. They'll still be able to pay it out going forward. And these are brands that may make a nice addition to a stable and boring dividend portfolio. I like owning some companies that are boring. I think it's nice to have some diversification into some brands you know are going to slowly grow and be a consistent provider of cash flow every single year. And of course, all 5 companies that we've gone through do just that. So thank you for watching the video to the end. I'm going to ask you once again to please hit that like button and subscribe, and I will see you in tomorrow's episode.